Hello, fellow investors. Welcome back to another episode of Ritter on Real Estate, where we teach you how to passively invest like a pro. Today, I've got a very special guest, long-term mentor and friend of mine, Joe Fairless. Joe's the co-founder of Ashcroft Capital, which has over 2.8 billion of assets under management. You probably mostly know Joe from his podcast, The Best Real Estate Investing Advice Ever Show, which is the longest running daily real estate podcast with over 500,000 monthly downloads. Joe really inspired me to start this podcast through what he had done. And in addition to that, Joe sits on the Alumni Advisory Board at Texas Tech. He's on the board of Junior Achievement, and he's just given back in many ways through his charitable foundation, Best Ever Causes. So Joe has really taken all that he's built in multifamily, and now he's making a big impact through his charity work as well. So Joe, thanks so much for coming on the show today.
Well, I appreciate it and thank you. And I'm looking forward to adding value in whatever way I can during our conversation. You know, your tagline, passively invest like a pro. I love that. And I think we'll have some good stuff to talk about that relates to that.
Yeah, absolutely. Absolutely. Well, let's dig right in, because this is clearly it's been an interesting couple of years for investing. I mean, pretty much whether you're investing in anything, but especially if you're investing in real estate. And I think you and I have a lot of similarities in our thinking about, why the way that things have changed in the market, why 2024 is really a great time to start buying apartments and start investing in real assets. And so I think it's important for people to hear some of the detail behind the headlines, because a lot of the headlines, you hear things, it's just all fear, uncertainty, doubt, right? That's what gets the clicks from the news media. But really, if you look at the underlying detail, I think there is this really unique pocket of time that has presented itself to be able to buy some great assets. And it's something we haven't seen probably since the great financial crisis, as far as where prices and things have gone. So um, without giving too much away, Joe, I'd love to hear your thoughts on, like, investing right now, and why is right now really a prime time to invest in apartment buildings.
We're about to experience a severe undersupply of apartment units. Um, what you'll read in the headlines right now, so it's important to have some context. What you'll read in the headlines right now, which is accurate, is that apartments are flooding the market. Their completions are flooding the market, and that is absolutely the case. From a historical standpoint, they're just the first half of this year, to put it in context, there have been 284,000 completed units, uh, which is more than the average for the full calendar year over the last 23 years. So the average is 217K new apartments hitting the market for a full calendar year. So 217K for a full calendar year. Just this year alone, 284,000 in the first half of the year. So from a historical context standpoint, man, apartments are absolutely flooding the market. That is making rents currently remain flat. I'm talking about a national perspective. Obviously, this is market specific, sub-market specific, property specific. From a national perspective, though, rents have been relatively flat during this period of time. And what is important to note is, okay, so we've got a whole lot of apartments hitting the market. So what is that doing to occupancy? And the fascinating thing about it is that occupancy has held strong for the last 3 months. Occupancy has been at 94.2%. It's stayed there for the last 3 months, 94.2%. So with this historical flood of new apartments coming online, the occupancy hasn't moved a bit. Now rents have remained flat, but occupancy hasn't moved a bit. And it's, 94.2%. So why is that? Well, there's a bunch of demand. There's a whole lot of demand. You mentioned the Great Recession. That's where a lot of this started from, when during the Great Recession, people didn't build new apartments, right? people didn't build anything during those 2-3 years. That created a big deficit of housing units. Tried to catch up from 2012 to 2022 or so, but during that period of time, there were about 3.5 million more new households formed than units completed. So even during the 2012 2022, there's still a deficit, and we're facing a major deficit of housing. So um, can the continued flood of new completions will it continue? Absolutely not. It's not continuing, because what we've seen is that this year there have been 59,200, the difference of almost 60,000 new apartments that have been completed, minus there's a deficit of almost 60,000 new apartments, minus the ones that have started. So look at the new apartments, look at the ones that have started, there's a deficit of about 60,000. So what's that telling us is that is the greatest swing from year over year of completed minus started since the 1970s. So we are already seeing the swing now from how things are going to be shifting. And the reason why is, we all know interest rates have increased, prices are higher, new construction doesn't pencil, regulatory issues across the board. It's harder to build right now. Just recently, if you look in the news, Jacksonville is considering a 1-year building pause on all apartments because the city's growing so fast, and they need to reevaluate if their infrastructure can withstand the growth. So they're considering pausing all new apartments for 12 months. So, and that's more of the exception, not the norm. But what absolutely is happening across the board is that the new permits that are not being sought after because the deals don't pencil. And so that's what's happening now. And so where does that leave us moving forward? Well, for the next 12 or so months, we'll still see the headlines of, hey, new apartments come into the market. But man, at around mid 2025, late 2025, that story is going to completely do a 180. It absolutely will, because a tiny bit of this is speculation, because there could be a black swan event that, who knows, maybe it makes building much easier, or maybe there's a new technology that comes out or something else that changes this dynamic. But the majority of this is fact. And the reason why we can predict what will actually happen mid 2025 through 2028 as it relates to supply and demand, only supply and demand, is because you have to get a permit to build. And then it takes 18 to 24 months to stabilize. So we can see this. We can see it in advance. We see what's coming. And so why is now a good time? Well, multifamily owners know this is taking place, so they're trying not to sell. But the ones who are forced to sell, man, this is when we can capitalize within this 12-month period of time or so on the opportunity that when apartments just cease to being completed and there is no new product coming online, that demand is going to soar, rents are going to soar, and it's going to be a very desirable time to be an apartment owner.
Yeah, I think that's really well said. You hit on a few points there. Let me summarize a little bit what I heard, and you let me know if I make sure I heard it correctly. So yeah, we're in this interesting window right now where current, well, supply and demand, right? Supply has run up, so rents have been relatively flat um, right now. But what we're seeing and facing is really this cliff of supply because of where we are with inflation on construction prices, materials and labor, and interest rates. it's very difficult to get a new construction project started right now. And even anecdotally from the developers that I talked to, I mean, many have said, and this was going into 2024, that they're going to start, maybe only 25% of the projects that they planned over 24 and 25, because they're not penciling out. And so what this is gonna cause, right, is this cliff, where supply is gonna just fall off, right? And we're gonna see that kind of in 25 and 26. We can predict that because as you said, there's permits out there that we can track, and we can trend the data, and we see this coming. And so while demand is continuing to increase because housing formation has stayed strong in the US, which is a great part of the US, which isn't happening in other countries, many countries in Europe. We're still growing. So houses are being formed. They need a place to live. We're in a deficit that's going to get worse, right? And then on, so that's the future. But right now, what's happened because of where interest rates are and because cap rates and interest rates largely move together, we've seen for the first time since 2010 current asset prices decrease, right? And we've seen this time where even in my own experience, we've seen cap rates expand, a half of a percent to a full percent on certain deals, which for folks, what that means is basically we're able to buy at a better value. It's less of a multiple on the income. We're buying assets at a better value. And we haven't seen that in, let's say 12, 13 years, right? That won't, that is a function largely of interest rates. So right now we're in a period where interest rates remain high. I don't think anyone expects interest rates to be this high forever. And I imagine about that time when uh, construction start falling off a cliff, we're also going to see interest rates begin to come down. We're already starting to hear some things from the Fed. And as interest rates come down, current asset prices will increase as well. And so it's like this interesting time right now where we have these depressed prices, right? Which is only a limited time, really a function of interest rates being up. So I think that's where you and I share this mindset of right now is a very unique buying opportunity. Um, I'll tell you one more thing I saw. So, Howard Marks, one of the most prolific investors out there with Oak Tree, in their annual event, he called out commercial real estate as a once in a generation buying opportunity, and he specifically drilled into multifamily and industrial as where those two opportunities exist. And his point was the exact same as you're making, all the same points, and it came down to really current asset pricing and future demand imbalance. And so there's a lot of smart people saying this out there, including yourself. But does that kind of package it up, Joe?
Yeah, absolutely. Yeah, absolutely. I mean, a lot, as I mentioned earlier, a lot of multifamily owners know this. Therefore, the ones that are selling, they are they're in a tough spot. Most likely, they're in a tough spot. So I mean, combine buying in an opportune time from people who are in a tough spot, you're getting some good deals. You
Yes.
can get some really good deals.
Yeah.
We
That's a
are
really
already
good way to say it. Yeah.
we're already seeing cap rates compressing on the deals that we're underwriting for Class A properties that we're looking at. The cap rates are around 4.85% or so. We have a property in Orlando we're buying at a 5.5 cap for a Class A because of an interesting opportunity that we're able to get ourselves into. Um, so, cap rates are already starting to compress. And I would say what is most compelling about this is I believe it's not dependent on interest rates decreasing. If interest rates were to stay the same, okay, let's just say they stay the same for whatever reason, fill in the blank for what takes place to make them stay the same. Um, you still got that severe undersupply of something that is highly sought after and needed. So what happens when you have a little bit of something, but a lot of people want it? Prices go up, right? And so, I mean, they're barring some black swan event, which could happen, but this will take place, and it's going to happen in about 12 months when you're going to see it start shifting like this, and then when it shifts, I mean, it's going to it's the momentum's gonna go quick, and you're gonna want to be an owner or a passive investor of multifamily during that period of time. And now, over the next 8 or so months, is the time to get in on it before that shift really starts taking place.
I completely agree with you. I think it's a good point about interest rates because the things we're buying now, I mean, the interest rates are priced in, right? We're buying at these rates. And so the rates stay neutral. Um, that's not a factor. Rates go down, it even multiplies the impact on value that we're going to see from this supply demand imbalance, right? And you're right, it's econ 101. If there's more demand, then supply, what happens is prices go up and it moves up the curve. And so, yeah, I appreciate that, Joe. I appreciate you laying this out for folks. I think it's a really compelling case. I think it's an easy way to kind of understand all the different things that are moving around and oftentimes helps to get below the headlines to really understand the news.
What I would say is that is what's happening on a macro level.
Hmm.
As we talked about, you know, what's most important is, okay, that's macro level, but is this particular thing that I'm looking at a microcosm of the macro level picture?
Sure.
So when as a passive investor, if you're looking at a deal, double check that does are you on the right side of the supply demand dynamic? So you look at, completions, and you look at absorption, and you see, where is that property at specifically over the next 5 years, and the operator should be able to tell you by, a subscription with CoStar, where what the projections are. Will the absorption outpace the supply in that particular submarket? So that's what you want to look at from a passive investor standpoint.
Yeah, that's a great little golden nugget right there. Because I think oftentimes people focus a lot on demand, right? And how much can we raise rents and what's the demand going to be? Not, and that's often what's presented kind of at the forefront. Focus on supply is usually less at the top of people's minds. But I think that, especially where we are right now and everything you've just said, focusing on that supply and what's coming is extremely important. So I think those are some great questions to ask as folks are evaluating deals. So appreciate that nugget there. So Joe,
Well, as you probably segue
yeah,
into this, I'm also a passive investor, so I'm thinking of that too.
right.
Like, as I'm presenting opportunities, I'm asking, hey, what's the absorption look like relative to supply and over the next 5 years?
Yeah. Yeah, absolutely. And that's just a great segue because that's exactly where I was going to go. I was going to say that, most people probably don't know this about you. I mean, we know of you from Ashcroft and everything you guys are doing, but you're also a very prolific uh, limited partner and passive investor. You've invested in over 120 deals as an LP, and so it's probably something most people don't know.
Yeah, I currently have over 120 LP investments. I was looking it up earlier, and I've invested in over, I think, 160 or
Wow,
so. I think. Don't quote me on that one, but some have sold.
it's a lot.
Obviously,
Yeah,
yeah, yeah, over 150, I believe, in total. I've
yeah.
I've invested in. So yeah, I'm our Ashcroft Capitals. I think I'm our second or third largest investor. Um, as an LP, but obviously I'm the co-founder also, so I'm the GP. But I have invested. I currently have money with over 50 operators as an LP. So I've seen some things and seen what works, and fortunately I'm invested with you. So thank you, and I'm grateful for that.
I appreciate you,
And
Joe.
yeah, well, you created the opportunity, and I'm just tagging along. So I'm grateful for that. You're doing the work, and I'm just benefiting. So thank you.
That's the goal, right?
Yeah, thank
Well,
you.
So tell me, with all these different investments that you've seen, with all these different operators, just what are what are your top lessons that you've learned on like how to be a good passive investor? What are the things that we should be looking at? And what are the things that you maybe have changed your perspective like over time after doing all these deals?
Yeah. So one thing that stands out to me is money is lost in the operations. So if there that to me from what I've seen is the biggest risk factor, the operations, because you tend to make money on how you purchase it and when you sell it. Certainly the value add business plan comes into play, but there's the operations component. Uh, what I've seen as a passive investor, the deals that so out of the 123 deals that I'm in now, one of them will likely lose 100% of my money. And it was because they weren't doing well operationally. The occupancy was like in the 80s or 70s, and they had debt on it that was floating, and they couldn't navigate that. When those two things are present, operational issues and some sort of debt issue, you're likely toast. That's what I've seen. And the operators that are able to navigate it are the operators who have solid operations. Maybe there's a debt challenge. I mean, with my company Ashcroft, we did our first capital call on a fund because we had floating debt with rate caps that were due. So we ended up doing capital call. Now we're refinancing a large majority of the floating debt into fixed interest rate loans, and then we're going to sell the other properties when the market turns around, and we'll navigate it. Um, Operationally, we're solid. So that's how we're able to navigate that. If there's a deal or an operator that doesn't have the operation solid and they have some debt issues, you're likely in trouble. So that's Monday morning quarterback. So now what can we do as passive investors when we look at opportunities? Because what's done is done. If you're in a deal passively, you're in a deal. So that didn't really help you much. But now for future stuff, what do we look at? So what I look at is, does the operator operate the properties and manage them, oversee the properties themselves? Do they have the controlling interest to make the decisions? And do they have the experience and track record that you want them to be making the decisions? Because a lot of times in our industry, you'll get people who um, raise money for things, but they don't have any decision-making power on it. And when things, go wrong and you invested with them, they're like, well, my hands are tied. Yeah, we should have done this, but I don't really have any decision-making power. So what I will only do from now on is invest with owner operators, people who have their own deal and are overseeing the execution of the business plan and are qualified to do so. I'll want to know, what type of projects have you done that are similar to this? Have you taken them full cycle? What were those results? What are the projects that you have done similar to this that you haven't taken full cycle yet? Where are you at with those? Maybe can I see the latest monthly update, just pick a random month? Can I see the latest monthly update from that? I just want to check in on, when you sent the financials, how things are going. That's the big takeaway from an LP standpoint. More emphasis on owner operators and the operational expertise.
Mm-hmm. Mm-hmm. Yeah, I think that's a great insight. I think that it's interesting, right? I mean, I think what we've seen over the past couple years as prior to that, I think cap rate compression kind of glossed over a lot of operational issues because you just had value creation because of value, prices kept going up and up and up. And you didn't necessarily have to be a great operator to make money. I think that's drastically changed over the past couple years. And I think the people that are still in it and being successful now, I think largely it has to do with you've got to be a good operator, right? You've got to be able to really run the property well to create value. And so I think that's a really good insight. What are some of the questions that you ask? You mentioned getting a look at like the actual financials and an update. I think that's great. What are some of the other questions you ask a sponsor or some of the due diligence that you would do to kind of dig in deeper in those areas?
Yeah, I would ask to remove the variable of cap rate compression, bailing them out on previous deals. Ask what was the NOI growth from start to finish? What percent did you increase the NOI growth? And get understanding of where did the value actually come from where they when they exited? Did it come from cap rate compression? Did it come from NOI growth? And from NOI growth, where did that come from? Was it the increase in rents, and or was it just something with something with operations that they did? Like, learn the story. And good operators will tell you the story about each property because they'll know it through and through. And it might not be the person that you're speaking to, by the way. You might need to jump on a call with their asset manager, for example, and that's totally fine and that's acceptable because the asset manager's job is to do just that. And the investor relations person might and probably won't know they won't know the nuanced details of the operations, but talk to the asset manager, talk to them, have a conversation with them about the most relevant deal that they're pointing to that says, yes, we've done this before. Okay, may I talk to the asset manager about that? I just want to understand where did the growth come from, and how you were able to exit. And then ask them what hasn't gone right. And when you ask them that, the type of way they respond is more important than than what they say. Generally speaking, if we- do they take ownership over their mistakes? That's basically it. Are they taking ownership? Are they stepping up to the table and saying, yes, we made this mistake. Here's what we learned from it, and here's how we're mitigating the risk from that happening again. Because I make mistakes, you make mistakes, everyone listening makes mistakes. But do the people we invest with own up to those mistakes? Because you don't want to get in a position investing passively with someone who is a narcissist or doesn't own their mistakes. Because if they don't own their mistakes, then maybe they'll start covering stuff up, and then they'll pretend that a big issue doesn't get bigger if it's not spoken, which it does. There's all sorts of issues with that, and they might be too late to try to course correct what they need to course correct. So that's another big thing from a just a comfort level and a confidence level standpoint.
Yeah. Well, yeah, those are great. So, I heard you say that I love the idea of digging into NOI growth to separate, if somebody says, oh, we had a 30% IRR, right, on an exit. It's like, well, how much was driven through true value add, right, through true NOI growth, and how much of that was from the market changing and the market improving cap rate compression. So I love that NOI idea and digging into that and the factors and the story, and then taking that further to actually understand kind of the case study around the deal, right, and showing the expertise, the understanding, and even speaking to an asset manager. I think that's really a next level of diligence that it could be really powerful. I think those are great little nuggets. And then, yeah, the idea of, if you've been doing this long enough, right, there are things that are going to go wrong. I think that's a big part of real estate, right? It's solving problems. That's how you become a successful real estate investor. You're always solving problems. So it's things are going to come. We're all learning. I think as a passive investor, you're trying to benefit from our lessons learned, right? Versus us making those mistakes, or you making those mistakes, right? So it's understanding the mistakes. I think, like you said, owning up to them, and then what are you going to do different, and what did you learn, and how has that changed, right? And I think that's super important. So I think those are great little, again, nuggets of wisdom for our passive investors to be able to ask some great questions and dig into the right areas. So appreciate you sharing those, Joe.
Well, I'm here to add value. I mentioned in the beginning, that's my focus. So I'm glad to hear that.
So as we wrap things up, I want to take you through our keys to success round. I've got 4 questions I want to ask you, Joe. Same questions we ask everybody. And the first one is just a great dovetail in our conversation. If you could only ask a deal sponsor one question before you send that check, what is the one question you would ask them?
I would ask them, um, tell me how many returning investors you have in your deals.
Yeah, that's great. It gets to a lot of points around probably how they communicate, how they've performed, right? Really cuts through a lot and how many returning investors. I like that. What are you most proud of in your career?
Uh, I'm most proud of the impact that I've made through the various things that I've done.
Absolutely, which you've had a huge impact on the industry, including my own personal story, right? And the growth and mentorship that you've given to me. So very much appreciate that. What is a book that everybody should read?
Book by James Nestor, I think it's James Nestor, called Breath or Breathe. Talks about
Yeah,
he writes about breathe through your nose, not your mouth, and all the benefits for doing that. And it's just a healthy way to a way to be healthier.
yeah, that it's a great book. I try to focus on that. I realized like maybe how bad I am at times at breathing
Yeah,
in the
yeah.
right way.
A lot of you listening will curse me for suggesting this book after you read it. It's like, dang, now I'm gonna be thinking about breathing.
I
It's
know.
like a book about blinking or something. It's like, don't think about blinking. So I apologize in advance for sending you down this rabbit hole, but you will be better off from a health standpoint after you read it and implement it.
Yeah, it is a really fascinating book. I agree. And last, Joe, what is your number one key to success?
Consistency. I did the daily podcast for, it's what, 3,500 episodes now, every day a week, 7 days a week. Now, I don't do those episodes anymore, but for the first 1,500 days, I interviewed people, maybe 2,000 days. So, I've interviewed more real estate investors than anyone in the world, I think. And it's just, that consistency is challenging, but there's a lot of growth that is forced as a result of that, and it's been beneficial. That's one example of many things where I believe consistency is much more important than, starting fast and then fizzling out, or going at something hard for a short period of time. I think consistency over time is the better approach.
Yeah, absolutely. And couldn't agree more. And you are just a great example of that and all you've been able to build off of what started as a podcast. I think you had told me a long time ago, you were in your New York apartment in your closet when you started that and everything that's grown since then.
Which my closet wasn't too much bigger than the overall apartment. Like it was like a shoebox. But yeah, I would interview. I would because it was loud. I lived right next to the street, obviously in New York, and Ninth Street and First Avenue. And I would literally put like a blanket over my head. I'd shove my face in this tiny little closet. The computer would be propped up on a pillow, so it would like go like this. And then I would try to interview people in a sound studio.
There you go. I mean, yeah, and look at all that's been built off of that through consistency. Awesome. Well, Joe, if people want to learn more about what you have going on, whether it's with Ashcroft or other things, how can folks connect with you?
Yeah, we have a deal that I mentioned briefly earlier. You can check it out at ashcroftcapital.com. Just go to current offerings. It's a deal where, a surprise, surprise, we're on the favorable side of supply demand over the next 5 years. The demand's going to outpace supply by more than 20.5% is what it's projected. For this specific submarket, residents make 115K a year at this property. So it's a great area, A class, or A class property built in 2021, and it's A plus school district, and it's it is the prototype for the type of deal that we want to get into right now. And I'm grateful to be able to share this with everyone.
Awesome. Well, yeah, everybody, we'll link that below. Make sure you guys go check that out. And Joe, thank you so much for coming on the show. Thank you for providing value today, giving us some great golden nuggets, and hope you have a great rest of the day.
Thanks, Kent. Thanks, everyone.
Thanks for listening to another great episode of Ritter on Real Estate. Hit the subscribe button to make sure you don't miss out on the content that will make you a better investor. Also, visit kentritter.com for articles, videos, and tools curated just for passive investors. Until next time, this is Kent Ritter with Ritter on Real Estate. Now go out and invest like a pro.